In 2022, Occidental Petroleum was the best performing stock in the entire S&P 500, generating a total return of 119%. But despite that big run up in price, like clockwork it seems that Warren Buffett just keeps buying Occidental stock over and over and over again through Berkshire Hathaway, basically any time that the share price gets below about $60 per share. In fact, Berkshire Hathaway now owns 211 million shares of Occidental Petroleum. As of the latest share count in the recent quarterly report out of Oxy, that represents 23.7% of the entire company. And additionally, he has warrants to buy a further 83.9 million shares at about $59 a piece, which, if he were to exercise those warrants, would take his total ownership in Oxy to over a third of the company, just a little smidge over 33%. This week, Occidental reported their earnings for the first quarter of 2023. So let's check in with how the company has been performing so far this year, and I'll take you through some of the highlights and lowlights of their recent earnings report. If you enjoy the video and haven't subscribed to the Investing with Tom channel already, please be sure to do so, but without further ado, let's get straight into the video. Now, before we get into some of the specific numbers this quarter out of Occidental Petroleum, I just want to talk through some basic fundamentals behind the business and why someone like Warren Buffett would invest in Occidental in the first place. Because one of the main reasons why Oxy performed so well in 2022 was just that there was a massive run up in the commodity prices in which Occidental sells, that being oil and gas. In 2020, Warren Buffett said when you buy into a huge oil production company, how it works out is going to depend on the price of oil to a great extent. It's not going to be your geological home runs or super mistakes or anything like that. It's an investment that depends on the price of oil. At one point in 2022, oil prices got as high as over $120 per barrel. Today, as a recording, oil is down quite substantially from that level. It's a little over $70 a barrel as I record this video. So it'll be very interesting to see how Occidental performed this year in 2023, where at least so far this year we've had much lower commodity prices. So let's go through some of the high level results out of this first quarter for Occidental Petroleum. Now, cash flow from operations came in at $2.9 billion, $3.2 billion before working capital. Capital spending was $1.5 billion, which meant that free cash flow, which is just operating cash flow minus capital expenditures, was $1.7 billion before working capital. Now, just to give you a feel for how significant that cash flow is relative to the price of Occidental, I guess that's why you invest in a business in the first place. You lay out cash today to hopefully get more cash back tomorrow. That $1.7 billion in free cash flow on a current market cap for Oxy of about $51 billion is a 3.3% free cash flow yield just in this single quarter's free cash flow. So if Oxy were able to produce the same cash flow over the next 3 quarters, you would be getting well into kind of double-digit free cash flow yield territory. Oil production came in at 1,220,000 barrel of oil equivalents per day, which exceeded guidance by about 40,000 barrel of oil equivalents per day. They raised their full year production guidance to 1,195,000 barrels of oil equivalent per day. That is a tongue twister. They repurchased $752 million of common stock. And just looking through last quarter's kind of quarterly report against this quarter, looks like shares outstanding are down about 0.92% just in these last 3 months. We know that Warren Buffett is a big fan of companies that can shrink their share count over time through doing things like share buybacks. It increases his proportional ownership in the business without having to lay out additional capital to purchase more shares. Of course, there's an opportunity cost within Occidental's business. They could have potentially done other things with that cash, but I think it's sort of a safe and effective use of capital that Warren Buffett quite enjoys, just to see a company shrink their share count through consistent buybacks over time. Occidental redeemed about $647 million of preferred stock that they had outstanding. Now, interestingly, that preferred stock, I believe, is entirely held by Warren Buffett and Berkshire Hathaway. So although they continue to be increasingly larger owners in the common stock of Oxy, their preferred shareholding is going down as Oxy kind of buys that back from them at a premium. Oxy Chem met guidance in the quarter, and guidance was lifted to $1.5 billion in pre-tax income for the year. If you're not familiar, OxyChem isn't the kind of core oil business. It's a subsidiary within Occidental Petroleum, which produces a range of different chemicals, things like chlorine, caustic soda, potassium hydroxide, PVC resins, and a range of other things. And finally, Occidental for the quarter reported earnings per share of exactly $1 per diluted share, which again, just to go through the calculations of how significant those earnings are relative to the price of Occidental, that represents a little under a 1.8% earnings yield just on that single quarter's earnings. So again, if you annualize that number and Occidental produce $1 of earnings per share every quarter for the full financial year, that would obviously get you to $4 of earnings per share, which would be getting up close to a double-digit earnings yield on the current share price. So overall, although Occidental remains highly profitable and is generating a lot of free cash flow, the earnings and cash flows are down quite significantly from last year when we had quite a lot higher oil prices. The earnings per share of $1 this quarter compares to $2.12 per share in the same quarter last year. The $1.7 billion in free cash flow they just reported, though it's still significant, is down from $3.3 billion in free cash flow in the same quarter last year. Now, alongside just releasing the kind of raw numbers in their quarterly earnings this quarter, Occidental does also hold a quarterly conference call with analysts where they give some commentary. We get some kind of insights from how management's thinking about the business, and a good chunk of the conference call is also analysts that follow the company being able to ask questions kind of directly to management and get some good feedback again from people who actually run Occidental's business. So there were a few good highlights out of the Occidental conference call. It started right out basically with a continuing theme of generating free cash flow and essentially returning it to shareholders through dividends, buybacks, paying off debt, and retiring preferred shares. Occidental continue to have a very clear roadmap in terms of how they plan to allocate the cash they generate in their business. They said they have an ongoing focus in maintaining their production base and paying a sustainable and growing dividend. And by sustainable, they really mean that they can still pay their dividend even if oil prices get a whole lot lower. They don't want to be in a position to cut their dividend simply because oil prices go down. So that's kind of what they're getting at with sustainable and growing dividends. They want to continue to repurchase shares and redeem preferred equity or preferred shares, again from Berkshire and Warren Buffett, enhance their assets, reduce their debt, and grow their cash flow. And looking back just a few years, Occidental have made a huge amount of progress in a lot of these areas. They have repurchased a lot of shares, they've repaid a huge amount of debt, and they've created a lot of value for the common shareholder. They display that on the slide here, which sort of shows the overall enterprise value of the company today versus a few years ago, and how the composition of that enterprise value has changed quite substantially to where a whole lot more of that enterprise value is made up by the value of the equity or the value, of the stock for common shareholders. Occidental have been going through a process of pretty aggressively paying down debt and essentially just deleveraging their business. And if you think about, for example, $1 million piece of real estate with, let's say, $800,000 of debt attached to it, which means you have $200,000 in equity, the $1 million house minus the $800,000 that you owe. If you pay off some of that $800,000 in debt, the $200,000 in equity can grow quite substantially. And that's essentially exactly what's happened here with Occidental. If we look at the progress over the past 3 years, the enterprise value for Occidental is only up about 29%. That's kind of akin to the $1 million value of the house going up 29% in our kind of house example. The market cap, though, is up 290%. That's kind of akin to the $200,000 of equity in our house example. And the way that they've done that is they've just paid off an enormous amount of debt with the enormous amount of cash flow that Occidental have been generating over the past few years. And adding to that a little further, even though the market cap is up 290% or about 3.9 times in the past 3 years, the share price is up even a little more, about 317%. And that's essentially directly attributable to the lower number of shares outstanding. So they've deleveraged, they've grown the enterprise value a little, they've grown the market cap a lot, and there's now less shares that make up that broader sort of market cap. So the common stockholder in Oxy over the past 3 years has done extremely well through a combination of those factors. And it seems like the runway for this sort of capital allocation framework really isn't over just yet. They said that they've so far executed about 25% of their refreshed $3 billion share repurchase program. And that's quite a contrast to what you would have seen in a lot of oil companies, a decade ago. In days gone by, when oil prices went up a lot, management teams would kind of have their eyes light up and suddenly want to really grow production and take advantage of these higher oil prices, which, by the nature of producing more oil around the globe, that would then drop oil prices back down, and it was really not a particularly healthy cycle for a consistent profitability for oil companies. But the attitude seems to have really changed. One of the very first questions that management got on the conference call was basically, if you get benefits from more efficient production and you generate a little more free cash flow as a result, what would you do with that free cash flow? Would you return it to shareholders, or would you try and grow production? And Vicky Holub, the CEO, said no. Any incremental cash flow that we can generate from whatever sources would go to share repurchases, and hopefully beyond that, the redemption of the preferred along with it. And one final note on the conference call with Occidental, there was a question around Oxy's low carbon business. There's been a bit of speculation that maybe that's why Warren Buffett's in the company. I'm not completely on board with that perspective. I think he just likes the cash flows the business generates, and he likes the capital return framework with the buybacks and dividends and so on. But it is a potential little kind of free lottery ticket that lives in Occidental. Occidental, if you're unaware, have basically this carbon capture or carbon sequestration business. They're essentially trying to take CO2 from the atmosphere and put it into the ground. And it's still very much in the development phase. It's not a profitable part of Occidental's enterprise yet. Revenue today is about $400 to $630 a ton is kind of the range that they give, against costs of $400 to $500 a ton. So it's really about break even, maybe very modestly profitable, but they did give some future ranges where they think they can get the costs down in their carbon capture business, and it could be a source of profitability moving forward. So overall, quite the interesting quarter for Occidental Petroleum. They're now encountering much lower oil prices than they had the benefit of experiencing in 2022, but they continue to generate free cash flow, and they continue to have a very strong framework of wanting to return it to shareholders through buybacks and dividends rather than grow production and try and chase potentially high oil prices in the short term. Warren Buffett said himself that an investment in a big oil producer like Occidental Petroleum, as an example, is really a bet on high oil prices for some period of time. So it'll be interesting to see how Oxy continues to navigate 2023, regardless of whether they get high oil prices or low oil prices. And it will also be quite interesting to monitor what Warren Buffett does with Berkshire's holding in the company, whether he continues to add, whether he potentially just holds or even sells, and if Oxy's share price does shoot up a lot over and above the strike price with his warrants, whether he chooses to exercise his right to purchase shares at that agreed little under $60 price on the warrants. So I do hope you enjoyed this video and this update on Occidental's latest quarterly earnings. If you did enjoy this video and you haven't subscribed to the channel already, please be sure to do so, and let me know down in the comment section below what your take is on these latest numbers out of Occidental, and more generally why you think someone like Warren Buffett might be investing in companies like Occidental Petroleum and Chevron, these big kind of US oil giants. But that's it from me for this one, and I'll see you in the next video. Cheers.